Jerome Powell's comments from Jackson Hole Economic Symposium fueled a 1,000-point market rout on Friday. The S&P 500 erased all August gains in one session on Friday. In essence, the Federal Reserve chair said the central bank won't back off in its fight against rapid inflation, and analysts are weighing the implications of higher interest rates kept in place for a longer time. As a consequence, Asian markets are all painted red this morning, with Japan's Nikkei leading gains, and the dollar extended its gains as well, hitting 20-year highs against a basket of currencies, among which the yen and the euro. For more on this now, let's go to Han Tan, who is Exinty Group Chief Market Analyst in Abu Dhabi. Han Tan, many thanks for being with us this morning. So first of all, why are investors so worried? After Powell's comments, surely restoring price stability of some sort will require action and a restrictive policy for some time. Then I wonder, how likely is this to lead to a painful recession?
Yeah, so it's likely that this will lead to a recession. Now it's a matter of the word painful, right? And that is a relative word because it's a matter of how deep or how protracted the recession could be. Now, the Fed believes that they can still avoid a hard landing, getting away perhaps with a shallower and a shorter recession. But I think overall, the narrative that markets are holding on to is that if the Fed persists with, like you say, keeping rates elevated for longer, I think that should translate into deeper economic pain, i.e. more job losses and a higher unemployment rate.
All right, interesting. And Han, when we speak about high interest rates, what are we really looking at? Because I think next month, markets already priced in a 0.75% increase in rates. And I wonder, by the end of the year, do you think we will see 3.75% interest rates in the US, 4%, or even more?
Yeah, so I think I keep in mind, to be clear, that for the September decision, markets have yet to fully price in that 75 basis point hike. I think when I checked this morning, it's still standing at around 80%. So there's still more room for those expectations to be firmed up. But you're right, looking further down the line, I think for this rate hiking cycle, not to end just this year, but perhaps to extend into the first quarter of next year, if we take the Fed's words at face value, we could see 4% or higher. But markets right now are still doubting that somewhat. As it stands, Fed Fund futures still only price in to peak just below 3.9%. But like you said, there's still a lot of data points to look out for and more policy decisions between now and the end of the year.